The year was 2023. It was a year that started with so much promise and potential. The markets were on fire, reaching new heights every day. Every trade I touched turned to gold. It felt like I had the Midas touch. I was a trading prodigy, destined for riches beyond my wildest dreams. Or so I thought. My confidence was sky high. My confidence soared with each passing day, fueled by a string of improbable wins. I felt unstoppable. Risk management? Who needed it? I was riding a wave of success. I was invincible, nothing could go wrong. Or so I believed. Then came the crash. It was swift and brutal, like a thief in the night stealing away my future. The market turned against me in an instant. My portfolio, once brimming with profits, was decimated. The numbers turned red and my heart sank. I watched in horror as my life savings evaporated before my very eyes. It was a nightmare unfolding in real time. The numbers on the screen blurred together, a sea of red ink mocking my hubris. I had lost everything. My dreams shattered. The weight of my failure pressed down on me, heavy and suffocating. I felt like I was drowning in despair. Doubt gnawed at my mind. I questioned every decision I had made. Had I been a fool to think I could conquer the markets? Was I just another overconfident trader? Was this the end of my trading journey? The thought of giving up crossed my mind. In the depths of despair, a flicker of determination ignited within me. I couldn't let this be the end. I refused to let this defeat define me. I had to rise above it. I would learn from my mistakes, no matter the cost. I would study harder, plan better, and come back stronger. I would rise again, stronger and wiser. This was not the end, but a new beginning. Humility is a harsh but effective teacher. The arrogance that had blinded me was replaced by a burning desire to understand the true nature of the markets. I devoured every book, article, and trading forum I could find. I immersed myself in the world of charts, indicators, and trading strategies, determined to unravel the secrets that had eluded me. Slowly but surely, a new understanding began to dawn. I realized that my previous success had been nothing more than blind luck. I had been gambling, not trading. To succeed in the long run, I needed a solid foundation, a set of proven strategies to guide my decisions. That's when I discovered the power of trend following, breakout trading, and scalping. These three strategies, each with its own unique approach, became my weapons of choice in my battle to reclaim my financial destiny. But more importantly, I learned the critical importance of risk management. It was no longer a matter of if I would win but how much I would lose when I didn't. Trend following, as its name suggests, is all about identifying and capitalizing on established market trends. This strategy is not about predicting where the market will go next, but rather about recognizing the current direction and making the most of it. It's like riding a wave, catching the momentum and going with the flow. Just as a surfer waits for the perfect wave, traders wait for the right trend to emerge. The key is to identify the direction of the trend and ride it until it shows signs of reversal. This requires patience and a keen eye for detail. One of the simplest and most effective ways to identify a trend is by using moving averages. These averages smooth out price data to help highlight the direction of the trend. For example, a simple moving average, or SMA, with a period of 20, will calculate the average price of the last 20 periods. This helps traders see the overall direction without getting distracted by short-term fluctuations. If the price is consistently above the 20 SMA, it suggests an uptrend. This is a signal that the market is moving higher and traders might consider buying. Conversely, if the price is below the 20 SMA, it indicates a downtrend. This suggests that the market is moving lower and traders might consider selling or shorting. Once a trend is identified, traders look for entry points based on technical indicators or price action signals. These signals help traders decide the best times to enter or exit trades. For example, a pullback to the 20 SMA in an uptrend could present a buying opportunity. This is because the price is temporarily moving against the trend, offering a better entry point. The beauty of trend following lies in its simplicity and effectiveness. By following the trend, traders can avoid the noise and focus on the bigger picture. By aligning ourselves with the prevailing market forces, we can increase our odds of success. This approach allows traders to stay on the right side of the market and capitalize on its movements. Section 4. Seizing the moment, mastering breakout trading. Breakout trading, on the other hand, is all about capitalizing on moments of volatility and market breakouts. Imagine a caged animal suddenly breaking free from its confines. That's what a breakout trade feels like. It's explosive, unpredictable, and potentially very profitable. Breakout traders look for price levels where the market has historically struggled to break through, known as resistance levels. When the price decisively breaks above this resistance, it often signals a surge in buying pressure and the potential for a significant price move. Traders typically enter long positions on a confirmed breakout above resistance, or short positions on a breakout below support. The key to successful breakout trading lies in identifying genuine breakouts and filtering out false signals. This can be done by using volume analysis, candlestick patterns, and other technical indicators to confirm the strength of the breakout. Section 5. Lightning in a bottle scalping for quick profits. Scalping is the art of profiting from small price fluctuations, like a hummingbird flitting from flower to flower, extracting nectar in quick bursts. It's fast-paced, adrenaline-pumping, and requires nerves of steel. Scalpers typically hold trades for very short periods, from a few seconds to a few minutes, aiming to capture small profits from each trade. They rely on technical analysis, order book dynamics, and market depth to identify fleeting opportunities and execute trades with precision. Scalping is not for the faint of heart. It requires a deep understanding of market microstructure, lightning-fast reflexes, and a high tolerance for risk. However, for those who can master this demanding style of trading, the rewards can be substantial. Section 6. The Guardian of Gains. Why risk management is king. No matter how skilled a trader you are, the markets will always be unpredictable. The financial markets are a complex and ever-changing landscape, influenced by countless factors that are often beyond our control. There will be losses. It's inevitable. Even the most experienced traders face setbacks and downturns. It's a natural part of the trading journey. The key to long-term success is not avoiding losses altogether, but managing them effectively. This means having a solid plan in place to handle adverse market conditions and unexpected events. This is where risk management comes in. It's not just a strategy, but a mindset that every trader must adopt to protect their investments. It's the bedrock of any successful trading strategy, the silent guardian that protects our capital from ourselves. Without it, even the best trading strategies can fail. One of the most important risk management tools is the 1% rule. This simple yet powerful rule helps traders limit their exposure to risk. This rule states that you should never risk more than 1% of your trading capital on any single trade. By doing so, you ensure that no single loss can significantly impact your overall portfolio. So, if you have a $10,000 account, your maximum risk per trade would be $100. This disciplined approach helps in maintaining a balanced and sustainable trading practice. Another crucial aspect of risk management is setting stop-loss orders. These orders act as a safety net, ensuring that your losses are contained. A stop-loss order is an order that automatically exits your trade at a predetermined price level. This is essential for preventing small losses from turning into catastrophic ones. This limits your potential losses on a trade and prevents emotional decision-making in the heat of the moment. By having a clear exit strategy, you can trade with more confidence and less stress. Finally, traders need to understand the concept of risk-reward ratio. This ratio is a fundamental aspect of evaluating the potential success of a trade. This ratio measures the potential profit of a trade relative to its potential loss. It helps traders make informed decisions about whether a trade is worth taking. For example, a risk-reward ratio of 1 to 2 means that for every $1 risk, the potential reward is $2. By consistently aiming for favorable risk-reward ratios, traders can enhance their chances of long-term profitability. Section 7. A New Beginning, From Ashes to Opportunity. My journey from devastating loss to financial freedom has been a testament to the power of perseverance, discipline, and a commitment to continuous learning. The markets humbled me, stripped me bare, and forced me to confront my own shortcomings. But in the process, they also forged within me an unyielding determination to succeed. The road to success in trading is paved with challenges and setbacks. There will be times when you doubt yourself, when you question your every decision, but it's in these moments of adversity that true traders are made. Embrace the journey, learn from your mistakes, and never give up on your dreams. Remember, the markets reward those who are patient, disciplined, and always willing to learn and adapt. The opportunity for success is out there, waiting for those who dare to seize it.